Welcome to module number 5, where we are going to explore the deferred tax assets and liabilities. In the previous module, we explored how to calculate the temporary difference. And this temporary difference is the difference between the carrying value of an asset or liability and the taxable value of the same asset or liability. So this is the temporary difference. Then second step is to take this temporary difference and then calculate deferred tax asset or liability. So deferred tax assets represent the future tax benefit that arise from deductible temporary difference or unused tax losses or tax credits, which can be utilized to reduce the future taxable income. So this is very easy to link between here, the benefit that you are going to receive in future and these keywords. Look at the word deductible temporary difference. Deductible temporary difference means that in future you are going to receive deduction in your tax. So this will be as a benefit as of today. So this will be translated to deferred tax asset. Look at the unused tax losses, because if you achieved operating losses in your current year or in prior year, and you didn't consume the tax benefits related to these losses, because government is usually giving you tax benefit if you are having losses or operating losses, and still you didn't use these tax losses. So this means that you are going to benefit from these tax losses in future. So you will have deferred tax asset as long as you will benefit in future. Look at the word tax credit. Tax credit means that you are going to reduce your tax amount in the future. So again, this will be considered as a benefit and this will be considered as deferred tax asset. So deferred tax assets can be utilized to reduce the future taxable income from all of these examples. So deferred tax assets means that you have benefits that you are going to utilize in future. On the other hand, deferred tax liability represents future tax obligations, which means that you are going to pay more tax in future that arise from taxable temporary difference. So look at the word taxable. So once you see the word taxable temporary difference, so immediately you have to understand that this will be translated to deferred tax liability, which will result in a higher taxable income in future. So as an example, if the company follow accelerated depreciation for tax purposes, this will result in future taxable temporary difference. It recognizes a deferred tax liability, as we explained before, because in future, your accounting depreciation will be more than the taxable depreciation. The tax rules will not allow you to deduct any amounts for depreciation in future. So your taxable income will go up and the deferred tax liability will go up as well. So as an example, if a company's accounting profit is $100,000, but its taxable profit is $120,000 due to a temporary difference. So the current tax liability, as we explained before, will be calculated based on the taxable profit, which is $120,000. However, the difference, which is $3,000 between the accounting profit and taxable profit, this difference does indicate the presence of temporary difference, which could lead to additional tax considerations in future. This difference, which is $20,000, will result in deductible temporary difference. Why? Because you are paying now higher tax, because now the taxable profit is higher than the accounting profit. So this will reverse in future and the accounting profit will be more than the taxable profit. So the taxable profit will go down and you will not pay more tax in future. So you have a benefit. So this will represent deduction in the tax in future. So you are going to have deferred tax asset in this case. Now let's analyze the deferred tax assets. Deferred tax assets, as we explained before, arises when accounting income is currently lower than taxable income due to temporary difference that will reverse in the future. So when it will reverse in the future, so this means that accounting income will be more than the taxable income, so the company will receive benefits, meaning that the company has to pay more tax in the current period than it has recognized for accounting purposes, which create repayment of taxes and will reverse in the future, and the company pay less tax in future. That's why it's created deductible tax amount. Deferred tax assets represent the future tax benefit that the company will receive when the temporary difference reverses, and it's calculated by multiplying the tax rate expected to be in effect when the temporary difference reverses multiplied by the temporary difference itself. Now let's start analyzing the deferred tax liability. Deferred tax liability arises when taxable income is currently in the current period is lower than accounting income due to temporary differences that will reverse in the future. These temporary differences are taxable in future when it reverses, meaning that the company is eventually able to pay lower tax expense this period, resulting in a future tax obligations and when this temporary difference reverses. This represents the future obligations to pay taxes on the temporary differences when they reverse in future. And deferred tax liability is calculated as the tax rate expected to be in effect when the temporary difference reverses in future, multiplied by the temporary difference itself. Now, let's take an example on deferred tax liability. If a company's accounting profit is $150,000, but its taxable profit is $120,000, due to the temporary difference, a current tax liability will be calculated on the taxable profit, which is how much? It is $120,000 as we explained before. However, the $30,000 difference does indicate the presence of temporary difference, which could lead to additional tax considerations. The difference, which is $30,000, will result in taxable temporary difference, which in turn means deferred tax liability. Now, what are the recognition criteria for deferred tax assets and liabilities? IAS number 12 provides the criteria for recognizing deferred tax assets and liabilities. Number 1, the probability of future economic benefits. A deferred tax asset is recognized only if it's probable that the entity will have future taxable profit in order to offset or utilize this benefit. Let's take an example. If an entity has a history of profitable operations and expect future profitability, so a deferred tax asset is recognized in this case because the company is expecting to have future profits that will be able to offset and utilize the benefits that results from the deferred tax asset. Number 2, the entity must have control over the asset or liability generating the deferred taxes. So if an entity has control over an asset with a temporary difference, a deferred tax asset or liability is recognized. Also, recognition is based on the expected reversal of temporary differences. So for example, if a temporary difference is expected to reverse in the future, so a deferred tax asset or liability will be recognized in this case. But if the temporary difference will not be expected to be reversed, so in this case, it will not be temporary difference, but it will be permanent difference. And the deferred taxes are not calculated on permanent difference because permanent difference means that differences that will not ever, never reverse in future. So this means that there will not be any deferred taxes in this case. Do we have any exceptions from recognizing deferred tax assets or liabilities? Of course. And the following exceptions is very important because you will see these cases when it comes to business combinations in IFRS 3 and IFRS 10. So deferred tax assets and liabilities are recognized for all temporary differences. So this is the general rule, except when the temporary difference arises from two cases. Number 1, the initial recognition of goodwill. So if the company is going to recognize goodwill from business combinations, so goodwill will not have any deferred tax implications. And the second exception coming related to the initial recognition of an asset or liability in a transaction that is not a business combination. And at the time of the transaction, affect neither the accounting nor the taxable profit. So if a temporary difference arises from initial recognition of goodwill, it's not recognized as deferred tax asset or liability by rules of IAS number 12.